What's happening, Mo Trenton traders, and welcome to our year-to-date performance review. Today we're going to take a deep dive look at my trading results year-to-date so far. I'm going to show you the level of detail that I go into when I review my trading performance, and I think this is one of the biggest things that a lot of traders overlook. They, number one, perhaps don't keep a trading journal, which is the first big mistake. But if you are keeping a trading journal, it is really important to review your historical results often enough in order to identify what are you doing really well so that you can continue doing that, as well as are there any red flags that you need to be aware of in order to fix those red flags, and that can hopefully boost and improve results for the remainder of the year, month, week, or whatever time frame you're looking at. I do a lot of performance reviews throughout the year. I do quite a top level review at the end of each week just to see how the week has gone, but I don't get too lost in the detail because there's not enough context within 1 week to draw any major conclusions from. I then do quite a detailed overview of my trading results at the end of a month just to see how my performance is looking month to month, and are there any things that I need to be aware of before I jump into the next month of trading. And then I get to my quarterly reviews and my H1 reviews. Now, this is where I do a serious deep dive analysis into my trading results. I've got a large sample of trades to work with for the year. There's going to be some patterns and some conclusions that I can draw around red flags, things that I'm doing well, things that I'm not doing so well, to hopefully improve results, like I've said, for the following quarter or the following second half of the year. And today I'm going to show you how I go through my historical results to identify any key things that I need to be aware of for the rest of the year ahead, and what sort of conclusions I'm able to draw from that analysis that I do. So let's jump right into it and see what we find. All right, so we're going to kick off first with an overview of the trading results. What this basically means is we're going to look at profitability by the various different markets that we trade, the various different entry methods that we use, our win rate, our strike rate, our average risk reward ratio, all those really important trading statistics that you should be paying attention to is what we're going to cover in the overview slide here. So first, starting off with the various different markets that we trade. There's a total of 9 markets that I trade, being the S&P 500, the German DAX. I then trade cable, euro dollar, pound yen, euro yen, the USD against the South African rand. I trade gold, as well as I trade Bitcoin. Those are the 9 markets that I trade that are focused on for the first half of the year. There is room to add other markets, but these are the core markets that I focus on right now. You can see at the top of the list, S&P 500 has done by far the best within the markets that I trade. You'll see that there are 3 separate columns. There are various different entry methods that I use. There is an aggressive entry, there's a split entry, and there is a conservative entry. Now, I'm not going to get into the detail of these, but just to show you the various different results that one could experience by applying the different entry methods that we teach, just shows you the kind of overall performance that each entry method would yield. If you focused on just the aggressive entry at a 2% risk, which is what I risk per trade, and I focus purely on taking aggressive entries for the year that we've had now, so the overall result that we've yielded year to date is 57.4%. That's using the aggressive entry at a 2% risk per trade. You can see the split entry is a combination of aggressive and conservative added together. That would have yielded a 40.7% return. And if you focused on just taking conservative entries at a 2% risk also, that would have yielded 24%. So you can see often the aggressive entry does produce higher profits, but what I've realized historically is that the aggressive entry does produce a lower win rate. So you're going to go through a lot more losing trades by taking the aggressive approach, but it tends to yield a higher result at the end of the day. The split entry gives you a bit of a best of both worlds, aggressive and conservative. So profitability is not as high, but win rate is a nice favorable comfortable medium between the two entry methods. And then conservative entry, you can see being far more conservative in your entry and your approach to the market is going to yield lower results, but your strike rate and your win rate is going to be a bit higher. It's all dependent on what kind of trader you are. Are you very risk averse? It's all dependent also on your trader profile type. We do provide a trader profile assessment on our website, which is www.motrentum.com. And in there, you'll be able to complete a couple of short questions. And at the end of it, it'll give you a result as to what your trader personality type is and sort of what is the best way for you to personally approach the market based on your trader profile type. All right, so you can also just see in terms of the number of trades that we've taken for each of these markets, you can see that Bitcoin has been by far the most active market for us this year in terms of number of trades. But that doesn't mean it would yield the highest result. Actually, Bitcoin is sort of sitting in the middle of the highest to lowest of the markets that we trade. So the highest yielding market right now is the S&P 500. We've taken 8 trades so far, and we've made 28.7%. Followed by that is cable, 7 trades yielding 14.3. Then pound yen, 3 trades at 6.1. Euro yen, then we've already spoken about Bitcoin. The DAX, just slightly in the profit. USD ZAR also just slightly in the profit. And 2 markets that we are down on this year so far, namely gold and the euro dollar. So overall, there are, majority of the markets are up. We've got 2 markets that are down. But when you consolidate all of that together on the aggressive entry, we are currently up 57.4% so far year to date. So that's our overview by market that we trade. The next thing that I want to look at is what has our profitability been like throughout the year so far. You can see that the start of the year was a bit of a rocky one. We had gone into quite a bit of drawdown, but we had quite a good November, December the previous year. So I wasn't too concerned about this. Drawdown is a natural occurrence for any trader. And so this is just purely a reflection of having a good couple of months in a row in 2020. The drawdown was almost expected, and that took place at the start of this year. We took 12 trades in January, and we were down 7.8% to start the year. February, things picked up. We took 11 trades, and we were up 9.5%. So we were slightly in the profit here, 9.5 on top of negative 7.8. We were just ahead, slightly in the profit for the year. So just above break even for the year as we kicked off and ended the second month for 2021. And then March rolled around and we had some serious trades that really brought in some massive profits for us. Now, I'm going to actually show you the trade of the year so far for us. The year's not concluded, but I want to just focus on what that trade was in March that brought in this profit, because it definitely was so far the trade of the year for me. And I want to just give you a bit of a snapshot around what that trade was. Then it's been pretty sort of consistent thereafter. April up 9.1, May a bit of a flat, slow month, took 10 trades but only made 2.5%, and then June has been another decent month. We actually only took 3 trades in June. It was quite a boring sort of slow month, only took 3 trades but still ended up making 9.3%, so no complaint there. The third thing that I want to look at is the 2 sort of entry methods that we use in the market. We use a 21 EMA setup and a TE, which is known as a traditional entry setup. Now, I'm not going to go into the details around these different setups and entry methods. If you want to learn a little bit more about them, you can head over to our website. You can sign up for one of our trials, and you can learn a little bit more about these trading entries and sort of how do we navigate the markets using the Motrentum trading system that we deploy into the markets. You can see the split is more favorable towards the traditional entry, so we've taken more trades there, 35, and it's yielded 36.3%. The 21 EMA trade, we've only taken 19, but it still yielded a decent profit of 21.1. Now, you can obviously see as we're going along the various different splits also on the split and the conservative entry. I'm going to focus mainly on the aggressive entry because that is the approach that I use, or that's the results that have yielded for this year using the aggressive entry. But I do keep all 3 in to show you that there is diversity and this is quite a robust trading system. So if you're not an aggressive trader and you're more conservative, there is an approach for you. If you want a good balance between aggressive and conservative, there's also an approach for you. And if you sort of find yourself more like me, where you are quite comfortable with aggressive entries into the market, then there is an approach for you as well. But ultimately, a good balance and a good split between the two different entry methods that we use in the market. Then just looking at our win-loss ratio on the aggressive, split, and conservative, you can see that they've yielded exactly sort of identical results. This happens from time to time. It's not always the case, but this year in particular, you can see that all three, aggressive, split, and conservative, have had equal wins and losses. In this instance, 26 winners and 28 losers. And you can just see in terms of the difference that each of these have yielded. The aggressive obviously producing larger wins on the aggressive side, whereas your split slightly less in your conservative, and the losses are almost quite identical in the various different approaches. And so overall, in summary, when you consolidate all this information up together, some of the key statistics that I look at is on the aggressive entry, my average winner yielded just over 4% when I had a winning trade. That was the average size of my winning trades. My average loss was around 1.67%. My win-loss ratio was 48.1%. My profit factor, which is the size of your winners divided by the size of your losers, is 2.4, and the expectancy of my trading system is 2.8%. Overall profitability, 57.4% so far year to date. And then the results for the split, you can see the average winner slightly smaller and the loss remaining, pretty much the same. And the conservative, the winner sizes are even smaller, but once again, the losses remaining slightly the same. The win-loss ratio is the same, and then your profit factor and expectancy will be affected depending on your average winner versus your average losses. So straight away, at a top level view here, we can automatically see what our performance has been like by market. So where have we done really well, and which trading system has done the best in terms of entry method, what our win rate is, how much are we making per winner, how much are we making per loser. And all of these statistics and all this information helps to further boost confidence in you and your trading system. This approach is very similar to any traditional business model. Any business out there will be doing annual and quarterly and first half reviews of their performances in terms of sales. Which markets have they done better in? Which products have they sold more of? Which products aren't doing so well? And so trading is no different. In this instance, we're not looking at which product is our best seller and which one's the worst, but we are comparing it in a very similar way in terms of which market is the best one for us this year in terms of performance and profits, which ones aren't we doing so well in. And you've got to approach your trading in the same way. If you were a business owner, you would be looking at the ins and outs of your performance of your business in terms of how healthy is it, how profitable is it, and trading is no different. You need to do the exact same analysis each week, month, quarter, half, and annual to ensure that you are continuously moving your business forward and making sure that it's continuously growing. The next piece of information that I want to spend quite a bit of time on is the underwater chart over here. Now, what is an underwater chart? This pretty much is showing you our equity curve so far for the year. So when you consolidate the various different trades that we've taken, you can see so far year to date, we have taken 54 trades, which has yielded the 57.4% profit so far. So that is just our equity curve. This is just showing you how our equity curve looked as we started to take trades. So we started off the year, the first trade we took this year was a winner. It yielded us 2.4%. Then shortly thereafter, we went into drawdown. We had a couple of losing trades. By our fifth trade for the year, we were down 4.2%. We had a small little rally, a couple of winners, and then we dropped off again. We had another streak of losing trades. And after the 13th trade for the year, we were down 8.6%. Thereafter, we bottomed out and we pushed up higher for our equity curve. We eventually had quite a few winning trades in a row. By the 20th trade of the year, we were up 7.6%, then had another little pullback. And this was the period in March where we had some serious winning trades. We had that big push up in our equity curve, and we had that outstanding month in the month of March. And by the end of March and by the 38th trade for the year, we found ourselves up 46.2%. Once again, a little bit of a pullback down to 37.5. And then we had a nice push up here during the course of May and June, where we eventually closed off the first half of the year, 54 trades down and up 57.4%. So that is our equity curve, the line that you're following over here. In the background is what is referred to as the underwater chart. Now, this refers to the peaks and troughs of your equity curve from when you hit an equity curve high and then you start having losing trades and you start to go into what is known as drawdown, which means that you have not made a new equity curve high on your portfolio, but you start to experience drawdowns and losing trades. And what this is showing you is the extent of drawdown that we experienced from equity curve high to the trough of that drawdown on our equity curve. So you can see here in this instance, I've got lines drawn across here. So these percentages and these numbers over here is what is linked to our equity curve line. And then the axis here on the left-hand side is the numbers that are referring to in terms of drawdown and our underwater chart. So you can see here in the first portion of the year when we had hit that 4.2% pull down in our equity curve, you can see here that we went underwater, we started having drawdown in our portfolio, and that drawdown from equity curve high to the trough over here, you can see that it was over a 5% drawdown. So this is 5% drawdown, 10% drawdown, 15% drawdown, and a 20% drawdown. You can see for the year so far, we've hit 5% a few times in terms of drawdown. We've hit 10% once. Historically, some of the worst drawdowns that I've had is over 20%, but as I've mentioned, I am risking 2% per trade. And often those big drawdowns happen after a relatively massive spike up higher in my equity curve. So it's all relative. A big drawdown can often be followed by a nice big push up higher in your equity curve. So you've got to just take it all into context. And so here you can see we were down over 5%, then we pushed up, but we hadn't made a new equity curve high until this sort of green area over here where price started to push up. So in terms of our equity curve high was this point over here. We only made a new equity curve high around here after our 20th trade of the year. And then we pushed up higher, had a few winning trades again, and we started to make new equity curve highs. So we were above water, then briefly below water, above and below. Then we had those big March trades, big spike up in our equity curve that pushed us up. And then we've had quite an extended period of drawdown that took place thereafter. So we hit a peak of 46.2, and you can then see we pushed down just under 10% drawdown here. You can see we came pretty close to 10%, but didn't quite hit it. We then hit a trough of around 37.6, and then we pushed up higher. And to be honest, it's been a nice big spike up higher here. We've had some good winning trades in a row now at the end of June. So it's almost expected now, perhaps in the course of July, that we're going to have a bit of a pullback, a bit of a drawdown, go underwater again. But eventually, over time, the edge will prevail of the trading system, and we should start making some equity curve highs once again. This underwater chart is a very important piece of information to me personally. It really helps me to push through those periods of drawdown. Every single trader is going to go through periods of drawdown. The extent, the length, and all of that differs from period to period. But ultimately, when I start going through a period of drawdown, this underwater chart helps me to really dig deep into historical drawdowns. How long did they last for? Which one was the worst one versus the current one that I'm going through? And it just helps me to keep level-headed, that I don't get too discouraged and I don't get too lost when I start having clusters of losing trades, because I take one look at this underwater chart and I just say to myself, nothing is different this time. This has happened before, it's going to happen again. I need to just persevere, push through, and carry on. And when I start to zoom out and look at it more macro, big picture, all I can see is my equity curve keeps on moving higher and higher. Yes, I have periods of drawdown, but I also have periods where I'm above water and I'm making new equity curve highs. And that just keeps me level-headed, confident to keep on pushing forward in the market when you start to have clusters of losing trades. This is very important because a lot of traders get discouraged when they go through drawdown. It is a very difficult period for a lot of traders, especially if you start to have really big drawdowns and it's ones that are larger than your previous ones. And by keeping information like this and historical data, it helps you to think with a clear head, not to go too far down the rabbit hole of being discouraged and losing confidence in your trading system. But this data will also allow you to pick up if you're making any serious mistakes in drawdown. So maybe you're going through a really bad patch of drawdown, you can go back to the other results and you can look at, well, is a particular market really causing bulk of the damage? If it's across all of them, maybe it's a trend across the general market. But maybe you'll pick up that there's one specific market in this period of drawdown. Maybe there's one market that's contributing tremendously to this drawdown. You can then look into that market and see, has anything significant changed? Are you making any trading mistakes? Are you breaking any of your trading rules? And the data and the charts and the analysis of this historical trading data allows you to start tweaking and adjusting your approach in order to further improve profits. The next piece of information that we're going to take a look at is what I refer to as my trade sample sizes. Now, this is courtesy of the late Mark Douglas, who was renowned for his book, The Disciplined Trader and Trading in the Zone. If you haven't read those books, they are a must if you're serious about trading. And he speaks a lot around trading psychology, and he speaks particularly around looking at your trading system in samples. A lot of people get lost in the performance and the outcome of their trades on a trade-to-trade basis. And what often a lot of traders don't do is zoom out and look at the performance of their trading system on a larger macro sample of trades when you add them together. Mark Douglas's approach and his view of the markets is that over a large sample of trades, the winners and losers are randomly distributed. But when you aggregate all of those wins and losses up together in a larger sample, that is what produces your edge within the markets. What you're looking at here is my trades for the year so far, my 54 trades that I've taken, grouped in samples of 25. So you can see here, this is just a unique trade ID per trade that I've taken. You can see the actual exit date that I got out of this trade, the month, the year, and the profit that yielded. You can then see my 25 sample trade over here. On a trade-to-trade basis, this is where a lot of traders get lost in the small little outcomes of each trade on an individual basis, but they neglect to look at it overall. Now, at the start of this year, like I showed you, I had quite a poor performance in January. You can see clusters of losing trades here, and any trader that maybe only started trading the system at the start of this year in January might have been extremely discouraged when they went through a patch of losing trades like this. But if you just push through and eventually started to group the trades together, you would see that although we had a rocky start to the year and we had clusters of losing trades, and yes, we were underwater and we had a negative equity curve for a small portion of the year, eventually over a larger sample of trades, the winning trades started to come through, and on a larger sample of trades here, 25 in this instance, you can see when we add up all these trades together, our net profitability was 10.5. When I split the 25 trades up into smaller portions of 5 trades, which is just something I like to look at on a smaller sort of sub-segmentation or a sub-sample of the larger sample, you can see there we were down 4.2, 0.4, then 3.3, 8.1, and then 2.8. And so you can see what the difference is here psychologically is when you're looking at these individual trades, looking at it like this on a trade-to-trade basis tends to affect you far more psychologically. But when you look at all of your trades on a larger sample like this on a 25 or a 5 trade sample, you can see that it makes the numbers a little easier to digest, and the edge of your system starts to prove itself on a larger sample of trades. In this instance here, on the first sample for this year, we've had, of the 25, we had 11 wins, 14 losses, and a win rate percentage of 44. You can see that our second sample of 25 trades went far better. We didn't have as many losing trade clusters. We had a nice random distribution of wins and losses. We had a little bit of a cluster over here, but some good winning trades. And you can see here in March where those big trades started to pick up, there was that big trade that we had on the S&P 500, which I'll talk about in a moment, where we had made 17.1% on that one trade alone. That pushed up our profits quite nicely. And you can see here, overall on this sample, we had made a 33.5% profit overall. And individually, you can see nicely spread and distributed, 12 wins, 13 losses, and a win rate of 48%. And now we've just entered our third sample of trades for the year. We're only sort of 4 trades into this so far. We're up 13.3%. We've had 3 wins, 1 loss, which is a 75% win rate. You can see that's a lot higher than the other 2 that I showed you. And that can only mean that we're going to have some losing trades that come our way. Losing trades is a part of doing business when it comes to speculating the financial markets. You cannot avoid the losses. You need to get through the losing trades in order to have the winning trades. And so we're quite early into the third sample of trades for the year. Yes, we're up, but there are going to be some losers that come our way, and we need to be prepared for that. But by looking at the information that I have, the historical data, my underwater chart, my overview statistical data for the year, I am not phased. When the drawdown comes around, I'm expecting it. I know it's going to come my way, and I need to just remind myself that I need to push through that, because eventually the winners will come through, and on a larger macro big picture sample of trades, I am profitable overall. I now want to take a look at our trade of the year so far. This was on the S&P 500, as we mentioned earlier. We got into this trade over here on the 30th of March. We consolidated for a little bit after entering, and then price just absolutely took off thereafter. And we subsequently got out of this trade on the 6th of April, early morning, just as the London session opened up. We decided to get out of the trade. Shortly thereafter, our trading system and our methodology gave us another signal to go long this market, which I was a little bit hesitant. I mean, after such a big move like this, I was a little hesitant to take another trade shortly thereafter. But you know what? Flawless execution and sticking to your trading rules are absolutely key. So we went ahead, we got into this trade again, roughly on the 6th of April, same day. We got in a little later that evening. We went long the S&P 500. This one didn't take off as much as the previous one, but still ultimately it yielded us a 4.6 R for this trade. As I said, we take a 2% risk per trade. So this one yielded around 9.2% profit on the second trade. And the first one, we had an 8.56 R on this trade, and a 2% risk on that yielded us over 17% profit on this trade. So between these 2 trades, adding them up together, that was bulk of the profits that we had made in March. And these 2 trades alone account for over 50% of our profits for the year so far, which is really good going. It's no surprise taking into account how the S&P 500 and the NASDAQ has been moving last year and this year. And so in summary, that is sort of the kind of detailed analysis that I do on my quarterly and H1 reviews, as well as I sometimes dig into a bit of detail on a month as well. If I've had a really good month or a really bad month, I like to dig into the detail and see where that came from and try and understand a little bit more around what kind of phase am I in when it comes to my trading, my profit and loss. So I hope you enjoyed that. I hope it gives you a bit of insight and something to think about around things that you should consider looking at when it comes to your trading. Are you focusing on the individual markets? Are you looking at your different entries? Do you have a trading journal? Do you record all your trades? Do you review it at the end of a week, a month, a quarter, a half? What sort of conclusions are you drawing from that data? And is it helping you to make some tweak and adjustments to your trading system and your approach to the market so that you can further boost and improve profits? If you would love to learn a little bit more about our trading methodology, the way that we approach the markets, and how the Motrentum Traders Academy can help and support you in your trading journey, why not come and pay us a visit at Motrentum.com, where you can sign up for a free 14-day trial, give it a test before you have to commit to anything, complete your trader profile assessment. You can set up a one-on-one with myself where we can talk about your goals and aspirations for your trading, and give you all the help and support that you need to become a long-term profitable trader. I hope you enjoyed the video. I hope it added value. And if you have any questions or queries around this video or anything else, leave it in the comments section and we'll be more than happy to reply back and answer your questions. So that's it from me. All the best, happy trading, and catch everybody really, really soon.